Welcome to Arnerich Massena's second quarter 2016 Market Insight. Hi, I'm Arthur Coyne, Senior Research Analyst, and I'd like to introduce Lee Shaner, our Arnerich Massena Summer Intern. As our summer intern, Lee has been working with our wealth management and analytics teams, and we're pleased to have her present our market commentary this quarter.
Hi, I'm Lee Shaner. Welcome to the WebReport Market Insight. In the second quarter, stock and bonds delivered positive returns. Bonds led the way as investors took a defensive posture. As June 23rd approached, all eyes were on the Brexit referendum, where the United Kingdom surprised financial markets by voting 52 to 48% to leave the European Union. The vote triggered temporary volatility in global equities and a more sustained downturn in the value of the British pound and British commercial real estate on speculation that companies might move away from the UK. Prior to Brexit, the UK was the second largest economy in the EU and ninth worldwide. While the Brexit referendum may not be legally binding on the UK government, it's expected to trigger a complex negotiation and withdrawal process. This could take several years as the UK and EU will be redefining their relationship across a broad range of areas. Until new agreements are in place, the relationship between the UK and the EU is likely to remain uncertain. It has been interesting to take note of global bond and stock yields. Global stock dividend yields remained steady in the second quarter at 2.7% as stock prices and dividends remained roughly unchanged. However, the big news was in the bond markets, where the yield on global investment-grade bonds slid to a new all-time low of 1.2% as bond prices were bid up on concerns of Brexit and slow global growth. At these low yields, bonds are expected to provide less future return while being more exposed to inflation and interest rate risk. Turning to inflation, we see that through May, both headline inflation and core inflation, which excludes the volatile food and energy sectors, were running not too far from the Federal Reserve's 2% target. If inflation were to average 2% over the next decade, a 1.5% yielding 10-year U.S. Treasury would leave investors at the end of 10 years with less purchasing power than they started with. Let's review fixed income returns in greater detail. In the first half of 2016, we saw bond prices rise and yields fall on strong demand. This price action, not interest income, led to phenomenal second quarter and year-to-date results. But it has driven yields to such a low level that fixed income returns are now being driven more by market fluctuations than by interest income. Looking more closely at stocks, we see that S&P 500 earnings have lately been in a gradual decline. Weak profits in energy and other sectors have contributed to an overall earnings recession which has been recently detracting from stock market returns. Among stocks, we continue to see U.S. markets outperforming their international counterparts, which were more directly affected by the uncertainty surrounding the Brexit issue. Commodities continue to rebound with double-digit price increases in energy, metals, and some agricultural products. Given concerns about low yields in the global growth picture, it's worth considering the choice between growth and value stocks. In this chart, we see that looking at rolling 10-year periods since 1937, U.S. value stocks have on average outperformed growth stocks by a wide margin, 4.7% annually. There have been only a few 10-year periods where growth stocks have on average outperformed value stocks, the ones ending in the late 1930s, 1999, and most recently 2015. If markets revert to their long-term norm, we would see investor demand shift towards value stocks, which typically have lower price-to-book value and higher dividend yield. In our second quarter positioning, we introduced a tilt toward value stocks within our global equity allocation. We are overweight equities relative to hedged investments due to our conviction in thematic and impact investing, and we continue to favor private markets over the public stock markets where appropriate. Among stability investments, we remain overweight, low volatility hedge relative to global fixed income because we are focused on credit strategies that manage interest rate risk. We continue to pursue return premium and yield opportunities across the entire range of asset classes through active management and innovative investment strategies. Your advisor will keep you informed regarding these opportunities as they become available. Thank you for joining us this quarter.